Hello everyone. So in this video I'm going to explain you methods of valuing inventory under IAS 2. So we need to value the inventory cost or net realizable value, whichever is lower. So what is cost and what is net realizable value? Cost. There are three methods, actually four methods. The LIFO, the last method, is not allowed in the recent times. So I will explain you the methods. Specific identification method. So the specific identification we need to use for the unique value items. For example, in Tata Motors, there are different models of cars: Tata Nexon, Tata Harrier, Tata Safari, etc. So if you want to identify the cost of Tata Nexon, then for producing the Tata Nexon, we need to specifically identify the cost for that particular model. We cannot consider that cost of producing Tata Harrier as the cost of producing Tata Nexon. We cannot do that. So this is the specific identification method for Tata Nexon. What is the cost? Second method, FIFO, first in first out method. So the example for this, let's say in the first day, let's take the example of the Britannia. The Britannia company produces in a day, let's say 100 bread packets. So the cost for producing one bread packet is, let's say, 20 rupees. In the second day, it produces same 100 breads, but the cost differs for producing the entire 100 breads. Why? Due to some fluctuations in the price, some economic crisis, or whatever the reason. For producing those 100 breads, the cost rise up, let's say 22 rupees. So in the end of the second day, totally in 2 days, how many breads have been produced? 200 bread packets actually. In the end of the second day, how many breads were produced? 200 bread packets were produced. So in the 200 bread packets, let's say some 90 bread packets has been sold. Now at the end of the second day, we need to value the closing stock. How much would be the stock of the bread? Out of the 200, 90 packets has been sold, 110 left. So in this case, what is the cost of this 110? Here we need to use the first in first out method. So the 90 breads which has been sold belongs to the first 100 packets of which has been produced or manufactured in the first day. So balance 10 breads is there in the first day's stock. So for that 10 breads alone, we need to value 10 into 20. So the balance 100 stock, we need to consider the cost of the second day, 100 into 22. So if you add these two values, you will get the value of the closing stock as on the second day. So this is the first in first out method. Let's come to the third, weighted average cost. So even in this, let's take the same example, this bread example itself, weighted average cost. So what we do, we take this balance 10 bread packets in the first day, and then the other two, the second day, the 100 packets. You add the cost of all these 110 and divided by, if you put 100, for example, 10 into 20 and then 100 into 22, add these two costs. If you divided by 110, you will get one figure. Let's say in this example, In this example, the cost of a bread is 21.81 is the cost of a per bread packet. So this is the weighted average cost method. So LIFO method, how we see the FIFO method, same way the LIFO method, but it is not allowed under IAS 2. It was the practice earlier, but it is not allowed under IAS 2 now. So what is the NRV? Cost we have seen there. Cost we have seen. Then what is this NRV? So NRV, net realizable value. So we saw that how to value the inventory, cost or NRV, whichever is lower. What is this NRV? So the formula is estimated selling price minus estimated cost to complete minus estimated cost to sell. Let's say you are going to sell this one bread. Let's take this example, one bread you are going to sell 25 rupees, and then this packaging cost, the marketing, packaging, logistics, these costs comes to, this is the estimated cost to sell. So these costs comes to, let's say, some 2 rupees per packet. I am telling 2 rupees. So if you reduce this 25 minus 2, the net realizable value is 23. So in this way we will value the NRV. So after valuing, we need to the important thing is we need to, at the time of valuing, we need to consider the total value of the stock, not a particular stock. Then in that case the cost of the NRV, the NRV value is 23. We have seen that 25 minus 2 rupees packaging cost per unit, 23 into 110 stock, you will arrive at one value which is above the cost. So what is the value of the inventory? Cost value or NRV value? It's a cost value. Yeah. Thank you everyone.